Hello there.
Hey, Mike. How are you?
I'm late. Uh, Sorry about that. I cleared out my browser search history, all that stuff settings because I was just getting too much junk, and it cleared out my password for this.
Yeah.
What is that hat you're wearing?
This is my son's 18U travel baseball team, the Iron Pigs. So I'm repping the Iron Pigs
The
paraphernalia here.
Iron Pig. What would an Iron Pig really mean? Like,
I don't know what the genesis of the name is. All I know is that when they win, they start to snort like a pig. So
seriously?
they have some pretty cool uniforms. Yeah, so it's fun. We were just in the Pittsburgh area for a tournament. This is their first travel tournament since Labor Day of last year, so they're just kind of getting the feel of playing together again after high school baseball, and it's fun. It's just a fun, it's fun to watch. Kids play at this age because it's more for the love of the game than anything else.
Well, I mean, this big boy baseball at that stage. I mean, these guys are probably throwing some pretty big heat, I would
Yeah,
guess.
you'll get kids consistently in the 80s. You'll get kids that'll get into the upper 80s. Last year, we had probably one kid in the tournament throw 90, 91. So for juniors in high school, sophomore, juniors, that's getting up there. This year, next year, the kids that obviously go on to the next level, they'll start to get into the 90s at this point.
Wow, what positions your son play?
My son is primarily a center fielder, and then he's a lefty, so he does some pitching, but primarily center field. That's where he's most comfortable.
Gotcha, gotcha.
So
Well,
it's fun.
all right.
Just like trading lumber, it's fun.
Absolutely. The people are
Uh,
starting to come in a little bit. Since we got a bit of a later start, let's just take a second and make sure we give people time to show up. There's definitely a lot of information to go over today. Um,
yeah, and I've got I know what we talked about. I'm going to run through obviously macro economy type stuff, obviously with equity selling off since last Thursday, but there's a lot of lumber stuff to go over, seasonal, historical, kind of where we're at versus last year. And obviously, we'll talk a little bit about moving average type stuff and try to relate what we're looking at technically on the charts to moving averages. Yeah, lots of good stuff. Never a dull moment trading, whether it's lumber or the other commodities or other markets. That's for sure.
well, I think you get to this point in the lumber market, and people are looking for something, looking for an indicator, um, and whether it's to an indicator to do nothing or
Yeah,
an indicator to do something. And what I think is happening right now is the overall economy, and what the stock market is I guess the tail wagging the dog or the dog wagging the tail. I don't know, but the stock market movement pauses the lumber market on days like yesterday, for instance.
yeah, no, and I think that in tandem with obviously the expectation. We're not only going to get a half basis, we could get three-quarter of a basis increase tomorrow. 10-year rates spiked up to 3.44. 30-year mortgages went over 6%. So again, all the headlines that actually related to housing, we could do no wrong 6 months ago. Now everything that comes out seems to be a punch in the face as far as future growth.
So crazy. All right, let's kick it off. June 14th, lumber futures from the free seats. Greg Kuda with Westline Capital, Mike Wisniewski with Materials Exchange. Greg, what do we know
Hello, hello,
today?
hello, everybody. So I think the obvious thing, again, we always start with, kind of aggregate market overview. The obvious thing here is the purple line. Like I just referenced, the 10-year notes have moved to 344. This is a new recent high. And this, unfortunately has begun to unravel. Uh, equities where you've not only retested, but in a convincing fashion, you've taken out the recent lows in equities and all three of the major indices. And lumber is getting lumped in. You have, I'll jump forward here. Uh, this is pretty crazy in that you look at the winners over the last 5 days. I didn't condense this list. This is it. Over the last 5 days, you're looking at commodities that trade in the US on bar chart. These are your only commodities that are up over the last 5 days. So this is it for all the commodities. There's probably 60 some commodities. This is it. So
Well, and
obviously,
the VIX is not a commodity.
no, it's a commodity on volatility. So we have extreme volatility. The only beneficiary here really are the physical commodities, the energy markets. Corn gets lumped in here, but fast forward or flip to the
Actually, pump back.
losers.
There's something
Yep.
I want to just kind of put a little foreshadowing on. Look at that U.S. dollar.
Yep.
The strong dollar. So, all right.
Yeah, no, and again, if you're globally trying to compete against the U.S., you're trying to devalue your dollars to make your goods cheaper relative to the U.S. So it's the battle, it's the battle to the bottom as far as everybody, kind of competing to kind of save face here with what's going on inflationary wise.
Okay.
So here's the losers, and when you look at the losers. Obviously, there's lumber. Here's all your equities, and then Bitcoin. Obviously, Bitcoin traded down to 21,150. So the bloom is definitely off the crypto rose here, where you've collapsed back down. And it's just risk off everywhere. I mean, that's the bottom line. This red list over the past 5 days, I would say 80-85% of commodities are on this red list here. So anything that trades futures wide, including even gold, has taken it on the chin as far as these seeming inflationary plays. The only inflationary play seems to be the energy markets. Everything else has gotten taken to the woodshed.
Wait a minute. Natty Gas. What's up with Natty Gas getting crushed there? Third from the bottom.
That's a good question. I'll be perfectly honest, Mike. I have not followed natural gas over the last week.
But things like that that jump out to me. Why is oil going up and Natty Gas coming down? So when I'm looking at markets, if everything in a certain sector is ripping, you're like, all right, great. But all of a sudden you start to see a crack in the foundation. Wait a minute, natural gas down 22%. That's an energy. You're like, huh. All right.
Yeah, no, it's the detachment with stuff like that. And then, you look at, okay, copper, palladium. Okay, technically they're precious metals, but they're also industrial metals used in industrial applications. But silver being down 5.79%, gold is down 2.17% over the last 5 days. So you would think that gold would get your inflationary flight to quality play. And again, when you look at this list, interest rates have been the big beneficiaries with energies, and that's about it. So kind of go back here.
Oops.
So I
somehow you stopped sharing.
Yeah.
But
okay.
You know what? I look at that list and I see industrial use items, copper, which is obviously wire, right? The perception that we could very well be going into recession is real, and purchasing managers are
absolutely. You're running inventories into the ground in anticipation of lower potential prices because of demand destruction. And I don't have the slide, but I saw something where they polled leading economists in our country, and the percent that think we're going to go into, at the very least, a soft recession is well over 65-67% now, and that's up dramatically from probably 30-35% over the last 6 weeks. So that number continues to grow. I'm going to try to find this presentation. The head economist at the CME, Eric, put on, I think it's Eric Nordstrom, put on, and don't quote me on that name, but he put on a presentation for one of the trade groups I belong to last week, and his compelling argument for commodities still being in a bull market cycle, and his analysis as to why was just phenomenal. Where you might have demand destruction, but the idea of this segregation of global trade now, where there's going to be less reliance on China, more domestic reliance, especially when it comes to base commodities, precious metals, rare earth metals. It's pretty impressive, and I will send this out if I can get it, but I wouldn't get overly bearish on the commodity sector as a whole. Obviously, lumber is its own unique animal, and we'll go over that. But
Well,
commodities as a whole, I'd be careful on getting overly bearish here.
Kyle is going to shoot some holes in your theory there, but thank you, Kyle, for sending this out. Recent reports claim natural gas is oversupplied by a little more than 2%.
Right. And so that's our domestic. And what people have to realize, there's a huge segregation of domestic natural gas consumption versus what Europe consumes. So Europe is primarily, they get 40% of their natural gas from Russia. Obviously, all of our natural gas is domestic based. So there's, we don't have that global reliance on natural gas like we do with crude oil now, and just, with the other energy structure.
Thank you to Kyle for that little bit of information. Always appreciate it.
I'm glad somebody's here. So big picture, obviously equities, and I want to run through this because there's a lot of good stuff with lumber. Equities have taken out the recent low, which is, I think it's the severity of how we did it over the last 3 days. That's more of a surprise, more so than actually taking out that low. And so when you look at, where have equities, and bad spelling here, but we're basically took out 38% retracement. So next in the queue is this 62% retracement, the 35 to 32 area on the S&P, and this is just your pre-pandemic, the onset of the pandemic low. That's all this is. So, okay, you're starting to see the headlines that our bull market is over. In the grand scheme of things, the bull market is not over. It's just taking a break here. You can see, again, this is your kind of start of the pandemic low. But, if you go back to the last bear market that we were in, and we referenced these percentages last week or the last couple of weeks. So your last official bear market was back in 2008, 2009. You're still, NASDAQ is still up over 700% from these lows. The S&P is up over 425%. The Dow is still up over 350% off of these 2008, 2009 lows. So, look, we're well off the highs from this last, all-time highs, but let's pump the brakes. Sure. That this market's come a long way in the last 10 to 15 years. Here.
Expand your memory a little bit and you'll not feel so bad, I guess.
Yeah. And again, I see, I think we're going into stagflation. I think from an economic perspective, and I'm an economist here as much as a trader, we are going into stagflation. The only caveat with stagflation is typically, the technical definition of stagflation includes high unemployment. So that's going to be the caveat with stagflation. You're going to see stagflation and high consumer prices, PPI, CPI, PMI. The only caveat, to truly define stagflation is a high unemployment, and obviously that's the only kind of part that we don't have right now. Employment is relatively low.
And that seems like a long way off unless we allow a few more people in this country.
Yeah, so we referenced the 10-year. We're up over 344 now. If you go back historically, here's the 30-year. So the big headline on CNBC yesterday was the 30-year mortgage is past 6%. Again, historically speaking, again, I know we're high for, we've doubled basically this year, but in the grand scheme of things, is 6%. It's high from where we just spun out of. But, again, let's pump the brakes. That 6% on a historical basis, isn't necessarily the end of the world. And so, kind of dovetailing now into housing. Well, what does this mean for housing? And this is from Zillow. This is from Allie Wolf, and she's phenomenal, by the way, with her facts and figures. Um, but change in monthly mortgage payment year over year. So again, I'm sorry, this is from the end of the year versus now. So you can see how the percent change in these metro areas in going from 3.25 to up over 6%, how you just get demand destruction as far as who can afford to buy a home in these metro areas. I mean, the percent increases speak for themselves. It's pretty dramatic, pretty substantial. When you look at, okay, CPI, this is the other part of this. CPI has obviously spiked dramatically, well up over 8 to 10%. If you look at non-core versus core, you could even make the case that you're closer to 10 to 12%. So again, less is more. People have less money. Things cost more. Uh, and then this shows up in personal savings right now. So look at your kind of start of the pandemic. You had kind of leveled out here. You get all the free money pumped into the economy, and now this is your Eiffel Tower 101. I mean, you've blown through kind of the old lows pre-pandemic, and people have less money. Like it or not, people have less money to spend on durable goods, let alone homes.
Well,
So
they're tapping into their savings.
yeah, absolutely. And you're exhausting savings, and then
Two
this
things have
shows
to
up.
happen. So two things happen there. You spend less, or you make more money.
Yeah, absolutely.
And the idea is that we're trying to get people to spend less money.
Yeah, and again, that's how do you slow inflation? You raise interest rates. How does the Fed slow the economy down? Well, you slow down spending. You slow down the money multiplier, and then ultimately that demand destruction ideally brings pricing back down, and that's the attempt right now. So
Wow,
when it
this
comes
is
to housing, well, what's the byproduct of this? Look at, again, this is monthly supply of new homes on the market. Look at where you were. This is basically 2021 right here, the start of 2021. Look at where you're at right now versus the start of this year. You're seeing this dramatic amount of inventory come on the market right now.
well. Now this is how many months supply, which is a calculated number, and it's the total number of homes available divided by how many homes were sold that month.
Right, right.
So while this doesn't necessarily say, oh, there's more homes on the market, it says that homes on the market are not being sold.
Yeah,
So
and you're definitely seeing homes sit on the market now. You're seeing the number of days on the market increase, and just so everybody understands, these gray bars are recession periods.
right. So I
So
think what there's to know here is there's two ways for this chart to spike or go up like this: an onslaught of new homes hit the market, or a dramatic slowdown in the number of new homes being sold. And as we know, there's some more new homes coming on the market, but the industry does not have the capacity to build any more than we're actually building right now. So what's really going on? The number of new homes being sold has slowed significantly.
yeah, absolutely, that's a great point. And then the other, I don't have this chart, but existing homes, yeah, you're going to start to see that build as well. But, again, unfortunately, if I go to sell my existing home, I still have to buy another house, and that becomes the conundrum as far as I'm probably less receptive to spec buying a new home until I sell my existing home first. So that
Correct.
becomes the other inhibitor to housing growth here. So again, the other big thing here, mortgage applications. We know that mortgage applications are leading indicators for single family homes. And you can see that, again, we're stair stepping down now with mortgage applications, and that single family part of housing starts is falling as well now. And again, you're still at really good levels, kind of if you look at growth kind of pre-pandemic here, you're finally starting to break below. If you're to draw a trend line, you're bumping up against trend line support here now. So again, volatility. We talked about the craziness of equities here over the last 3 days. So the volatility has increased dramatically here in equities. And so what does this mean for lumber? Lumber volatility is definitely historically still high, but you've started to moderate from where we were in the Q1 of this year to where we're not nearly as we're still historically volatile in lumber, but the volatility is getting sucked out of our market. Historically, you're still at above average type historical volatility, implied volatility levels. And so what does this mean? Options are still expensive. Call options are expensive, put options are expensive. You still have increased implied volatility, so options are still more expensive right now.
Well, but I have seen a little more interest in selling options.
Yeah, no, and I mean, like I looked at August 450 puts today. If I could sell those at $20, I'm basically getting long July at 420, and that 420. If I can get long July at 430 through the end of July, if I could sell September, the September puts for 450 were $2 more expensive. No, I'd rather sell the August and take advantage of that time decay, which is going to happen a lot sooner. But no, I think now, and we'll kind of go into lumber historically and seasonally. I know we talked about last week, Mike, big picture updates, looking for a bottom, and we'll kind of cover each of these as we go through the remainder of the slides. But some of these are starting to stand out that we're getting closer to a bottom here, and I'll kind of reference them as we go through. And then the other thing, we'll kind of reference, I know we wanted to talk more about technical indicators. What is a moving average? You can read through the textbook definition. We'll show specific examples on some of these charts of how you would look at moving averages. So let's jump into lumber.
Let's jump into lumber. Here we go.
So weekly continuation, we took out November lows in this 550, 530 area. Now you're setting up to retest the lows from a year ago in this 500, 490 to 448 area. The significance of this year versus last year is that you're about 4 to 5 weeks ahead of where the pace you were at last year. Last year, we didn't make these lows until the middle of July. This is July expiration right here through the middle of August. So we're setting up seasonally to kind of retest these lows, or the potential to retest these lows into seasonally when I'm gonna here's a daily.
Going what Matt Lehman had been talking about that all spring, that we were ahead of, from a time standpoint, a bit ahead of all of his traditional turning points, or historic turning points.
Yeah, and so let me jump forward here and we'll come back. I just want to, so here's your seasonal, and seasonally markets have a tendency to bottom out into the third week of June. So like June 21st into the US 4th of July. So typically you'll get this bottoming as people buy ahead of the 4th, where they don't want to deal with lumber going into the holiday. So seasonally, we're kind of more in line with kind of lower lows going into the historical seasonal lows. So this is starting to set up. You can see this red line is last year's chart. And again, we're 4 to 5 weeks ahead of where we were a year ago. Here's, you can see the different years, and this kind of, this is a better representation. Here's a current. So the green is versus the last 3 years, the last 5 years. So we're below where we were on a 3-year, 5-year average. Now, again, these averages get skewed by a market going to $1,700. You pull those moving averages higher, but you can see how we, over the last 3 years, 5 years, we bottomed after the 4th of July into the middle of July. But from a pricing standpoint, you're well below now where you've bottomed over the last 3 to 5 years. I'm going to jump back because I think this gives a better representation. So here's July. And again, you see the moving averages here. The one moving average I'll reference here is this blue line is the 9-day. And for me, the 9-day is kind of a leading indicator moving average. It's much more sensitive because of its compressed time. It's more reflective to picking tops and bottoms. And you can see once you rolled over under the 9-day here and that 9-day moving average slope started to flatten out, the market never looked back. And every time you've touched the 9-day moving average, it's become a sell opportunity. So at some point, you're going to get a rally back to the 9-day. That 9-day in July is in the 575 area. Obviously, it's still downward sloping. So the lower we go, the lower this moving average gets. But for me to be convinced that this market's bottoming from a moving average standpoint, at a bare minimum, you'll start to close. You'll see this moving average, this 9-day moving average, the slope start to flatten out. And then you'll start to get consecutive daily closes back above that 9-day. And then that allows for an attack of the 20-day and some of these higher moving averages. So this is, and thanks to Alex at Stone for putting this together. Here's historical July contract. So again, we looked at, I'm going to go back to this. This is the last 3 to 5 years. So if we go back to July, here's your 3-year average. Here's your 5-year average. And again, this is July lumber futures. The other one is a cash historical average. So 3-year average is a 483, 5-year average is a 484, 10-year 20. So when you look at these moving averages, what's relevant? Where did you have this big paradigm shift in lumber pricing? Is the 10-year moving average relevant? Is 5-year, 3-year more a reflection of reality because of higher cost of production? But you can see, July, the low is 518.50 today. Yesterday, we got down into that 517 area. We're still above the July 3-year, 5-year average type price levels, but you're getting close to these numbers now. And typically, when you get within 2 to 5% of historical numbers, that's good enough on either side of that, where you don't have to get absolute, you don't need to revert back to absolute historical numbers. You can be within 2% of that, under or over. 2 to 5% is typically good enough.
All right, let's get into some of the statistics here.
So here's September. You can see, just run through these. 5-year average in September is 512. 3-year average is 582. So you look at September, you're below those 3 and 5-year averages now. November, you're still above. And so again, this gets into the carry structure, the contango carry structure, where you're going to have the real lows in spot market. You're going to have the real lows in physical cash. Everything else is going to stair stepped up because of the cost to carry. So we talked about, what are signs that you're going to bottom out here? And for me, I'm a huge spread trader. I love the spread trade. So this July SEP spread, we talked about how you were getting erosion to the downside, that July's been leading the charge to the downside. And in a downtrending market, that should happen. When the market ultimately is going to bottom, then July should begin to act like a front month. July still has greater open interest versus September. So the one huge thing between yesterday and today, last week, this July SEP spread bottomed out in the negative 26 area. Spread came into 370 over today. Right now, that spread's basically even money, flat, a buck under. Yeah.
Last trade, 525 in both.
So what does this tell me? That the funds are done selling July. Okay, they've been pounding July to the downside on the CFTC numbers. Now the funds have shifted into September. So we know that new commodity fund selling is going to materialize in the September contract. And more important to that, going to the CFTC, we'll come back to this CFTC numbers. We know that managed money has this huge net short position, and this is all allocated in the July contract. So at the very least, by month end, they have to either roll this position into September and or liquidate the July. So we're at that point now where the new selling is going to materialize in September. the liquidation of existing shorts, speculative shorts, is either going to get rolled out of July by month end, or they're just going to outright liquidate their July. So that's your first real sign in my mind, going back to this spread, that the spread structure in the front month is indicating that the market is trying to bottom out here.
Yep. And
And
I got two things. First thing I look at is it's a mature move. Like you just have to look at a chart and you say, wow, we've gone a long ways.
yeah, absolutely.
Then now
Absolutely.
you start building up a bigger case for that. Oh, wait a minute. The spread's kind of bounced here. We're back to even money. So now we got two little indicators working for are we at a bottom or getting close?
Yeah, and again, technically versus fundamentally putting in a bottom, are the funds trading off of technicals? Fundamentally, we know that this market's getting dumped on left and right. And look, the funds could be just purely watching interest rates and saying, okay, we're back above 6%. Housing is dead. You can officially put a fork in housing. We want to get short anything housing related because the demand's just not going to be there. But technically speaking, I'm more interested in watching this July SEP spread, knowing that the commodity funds have this net short position, because when I go back to the CFTC numbers,
Yeah, it's right there.
commercials are just getting beaten out of this market. Okay, you have long liquidation.
Actually, look at what I see on this chart. People exiting the market altogether.
Yeah. No, you're getting, so you've had convergence, and so when you look at here's July. Okay, you've had convergence in the basis. There's July, there's September, there's November. So basis convergence has taken place between cash and futures. So that explains, just above and beyond. Okay, we know we get margin call liquidation of longs, but that's a big reason why commercial longs are exiting, because they can buy the cash now, equivalent of futures, and commercial shorts are just profit
if you did some forward pricing, which you and I were beating the tom on that 2 months, 3 months ago, saying, look, don't buy cash. That's ridiculous. If you have a project you need to cover for, that you need shipment in June, you should be buying futures or buying a forward price. And that's what happened. The long positions are exiting their long futures and turning it into an actual cash trade.
Yeah. So this doesn't surprise me. So the other sign that we'll look for as far as a bottom is in place is that ultimately you'll start to see.
Hang on a second. Look at what does surprise me. The non-reportable positions have basically gobbled up everything that was in the producer merchants.
Yeah. And this is this is always your kind of fast money in and out. Anything you can't lump into these other segments gets lumped into here from a position standpoint. So the other reportables here are greater than 25 contracts. These are less than 25 contracts as far as the CFTC is concerned. So again, for me, I'm watching this because I know that this position is short July. They have to do something with these Julys.
Yeah,
and the idea that all these other Julys exist. Look, there's going to be your usual suspects, that EFP July, but in a downtrending market, you're beating longs out of this market continuously. You're energizing the shorts. They have the momentum. The second that momentum stalls out, for me, this is the technical reason why you could get a rally, and it has nothing to do with the fundamentals of housing or lumber. It has everything to do with, if these guys decide that they want out, at the very least, they're going to roll into September. This could be the catalyst. When you go back to how could you get back above, if we go back to the July chart here, how could you get July back above the 9-day? Well, if the commodity funds are going to liquidate 400 contracts or half that position, and they just do it all in one fell swoop, that's how you could get a bigger rally where, okay, wait a second, fundamentally, this doesn't make sense. Who's going to chase Frazier at 620? They're officially still 620 ask. It could have everything to do with the commodity fund liquidation of a position to drive to some higher number here.
Yep, for sure. And look, it's July. These guys take off the month of August, so they're going to exit their positions.
Yeah, and then the other big thing, seasonally, we know that seasonal shutdowns, especially in the East, are going to happen here. And if the mills are smart, they're going to take an extra week off on either side of, their seasonal shutdowns in July and August. And the expectation is the lower we go here, you're starting to see sawmills complain about selling below cost of production. We're going to trigger anti-dumping. We've got we've drawn the line, line in the sand. These are the floors. Well, floors become ceilings unless you do something about it. So, if sawmills are listening, if you don't like these numbers, then do something about it in the form of curtail. That's what it's ultimately going to take fundamentally to kind of shift the supply to demand dynamic right now. So,
why don't we just touch on the basis real quick, and then we'll go to the moving average.
yeah, so July, again, we've had convergence here across the board. And again, this is reflective, you're going to pay more now in a contango carry market. There's going to be a cost to carry associated with going further out on this curve where you're going to have to add something. The cheap wood's going to be loaded into the spot month, loaded into physical cash. So for those, like what's my strategy here is I want to know my own business item by item, what I need, when I need it. And then I want to look at the historical seasonal numbers. I want to go back and look at those, where is my item from an investment standpoint on a 3-year, 5-year, 7-year, 10-year average. And I want to itemize out very specific items. And if there's value, if you're at investment type levels and you need that wood in anticipation of what lies ahead, then I think on an item by item basis, you have to go out and figure out where value lies in what you're going to be buying from a physical cash standpoint. Because to lay it off in futures, that's fine, but you're going to pay some kind of cost to carry. You're going to pay some kind of premium in this carry structure. And that's just the nature of a bear market structure now. So we've gone from that bull market structure to a bear market structure. And then we'll jump into moving averages, but car velocity is kind of ahead now of where we were the last couple of years.
Zero issues with cars moving.
Yeah, I mean now with a declining demand structure, look, mills are still late shipping, but the sense of urgency from a demand perspective obviously has kind of taken the wind out of, well, we can't ship the wood, again. Less is more. People are going to do less with more. And then let me see here if there was anything. I'm going the wrong way. I think that was it, Mike. Just everybody's aware. We have housing starts on Thursday. I can't imagine that's going to be a good number. And then the big thing is tomorrow afternoon, 2 p.m. Eastern or thereabouts, you're going to get the FOMC meeting at 3 p.m. Powell will speak and kind of give his analysis of what he sees and why they did what they did. So the markets will be completely fixated on this tomorrow. And then for our industry, we'll be fixated on Thursday morning.
Now, just to wrap up the whole economic conversation before we move to moving averages, I read yesterday, and I got to figure out where the heck I read this. The big the funds that have been buying single family houses are building the war chest, which I think is interesting. We still need homes. Like these houses still need to be built because of household creation. If the population can't afford to buy them, what's going to happen? These big funds are sitting back with a pile of cash. They will buy those homes and then rent them back. In fact, I read in this, I'm thinking it was on Bloomberg. One big fund was working with a major national home builder for 7,500 units. So I think that's interesting. There is an underpinning to this housing market. Even if it looks like it could be bad, we could see these money managers put their money to work in housing.
Well, I'm going to, let me just, the other thing I want to reference, and I don't know if I still have it from last week. Let me see if I have it. I'm just going to reference one thing. This is the other big component. I'm sorry, I'm kind of, let me see if I can find it here. If I didn't take it, this is the slide deck from last week, but Yeah. Where's it at? Here, let's see. Oh, here it is. No, we're getting close here. You know, I apologize, but there was a chart we looked at last week that showed rent, and so that's the other huge component of can the idea of these large aggregate funds accumulating housing. Again, they're not accumulating the housing as far as to go spin it off. They're accumulating the housing because there's still a housing shortage and rents are up dramatically where they're buying something to rent it out, and that becomes the profit model, is that they become rental properties, in single family home rental properties. And that's the other component of housing as far as some of these big aggregate funds, accumulation of homes, they're going to turn them into rentals and reap the rewards of inflation and rent pricing.
Yep. All right. Moving average. Moving average is very, very simple. You stand where you're at in time and you look backwards for a number of periods. You add all those periods, the price during those periods up, and divide by the total number of periods. You come up with the average over that time period. So on this chart, what you notice is that the green line, which is the 200 moving day average, is relatively more flat versus the 50-day moving average. So you're making the assumption that every bar on this chart is 1 day. So if you start at the end here and you go back 50 days, it takes you probably back to somewhere around here, and you add the closing price for every day, and it puts you right at this black line. If you were to say, instead of a 50-day, if you did a 10-day moving average, this line would be steep and pointing down. So really what it does is it just gives you an easy way to look at what happened in the last 10 days, what happened in the last 50 days, what happened in the last 100 days. And it is not a leading indicator. It is by all means a trailing indicator. I think this right here shows it really well. Oh, geez. I wanted to see that. This chart. So you can see the line is more, the brown line is absolutely more sensitive. It's measuring more of these red bars than the blue bars. The pink line is less sensitive. It's measuring more of all the blue bars, or measuring more bars going back. So simply that's what it is. Now I know, Greg, if you could show some of your charts that have a lot of moving averages on them. And
Let me see. Are we still sharing here? Yeah. So here you go. Here's a July, and you can see all these lines, and I send these out, and people are like, well, what are you sending me? So when you look at all these downsloping lines, the closer you are to the actual bars, these are the actual daily price changes, the shorter the term of the moving averages. So again, this blue line here is a 9-day. This red line is a Bollinger Band, but this is an 18-period Bollinger Band. This blue line here is a 20-period moving average. And then you stair step up into the 40-day, the 44-day. This red line is a 50-day. And then this yellow line here is a 200-day moving average. This black line here is a 100-day moving average. So you can see when lumber made the highs back in April, you traded up to 100-day moving average, you traded up to the 50-day moving average, you traded up to the 40, the 44. When you get this kind of meshing of all the Bollinger Bands, that's usually a good indication that becomes a big pivot point, an inflection point on the charts. And so something else I'm going to point out with the moving averages, I always look at the slope of the moving average, and you can see as this market topped out back into February, the moving average slopes were all positively sloped. So typically when you have a positive sloping moving average, it's very difficult for the market to reverse course and stay under a positive sloped moving average. What you typically need to see is a rolling over of those moving averages, where instead of trending higher and higher, the moving average, the slope flattens out and begins to trend lower. And so here's your perfect example. Okay, market comes back here. You test moving averages that are still theoretically positive sloped here. The moving edge averages start to flatten out. Once they start to go negative, it becomes more difficult to get the buy paper to stay above. You need to see the new blood more so than just stopping people out to support this, to kind of push back up and retest the highs. If that doesn't happen, these moving averages start to roll over and the buy becomes a sell opportunity. Your initial
All right,
support turns into resistance.
I'm going to interpret what Greg just said for the layman.
Sorry.
Every trader, every person involved in the market has their own time horizon and their own risk parameters. And if you are a fast trader, someone who gets in and out of the market, you're typically going to use a smaller moving average number, like a 10-day or 9-day, like Greg was talking about. If your time horizon is on a longer horizon, you don't want to have what would be a false indicator. You might be using a 40-day moving average. And your typical willingness to take a larger loss, you're more willing to take a larger loss, and you're going to look for a much larger win. So in looking at moving averages, the first thing you have to really do is look internally and say, what's my risk parameter and what moving average matches up with my style? And then when you're looking at a chart to analyze it, and you start to, look at things like Greg just brought up.
So that's a great point, Mike. And so so again, volatility determines what time frame you should be looking at. I trade a lot of mini S&Ps. This is a 60-minute intraday chart on the September S&P. So yeah, this is just the collapse since last Thursday. You went from 4,100 down to 3,730 here so far, but this is a 60-minute chart. So look, here's that 9-day. The market held the 9-day. That 9-day slope flattened out, started to push higher, so that allowed the S&P to break back up here. This is your Bollinger Band. You're stuck in this bigger range. You can see you came down under the 9-day here, floated back up into the 9-day. Look at that 9-day slope is down. So again, this is a 60-minute chart. So when I look at this, when I'm going to trade the S&P, I look at 60-minute charts. I look at 5-minute charts. This is a 5-minute chart. So these moving averages are a reflection of this time frame of the chart I'm looking at. So this is a 5-minute chart. This is instead of being a 9-day moving average, this is a 9. This period is based upon a 5-minute chart. So this 9-day average becomes a 9-minute moving average or a 60-minute moving average. So all these moving averages, depending on what kind of time frame you want to look at, here's a daily chart on the S&P. All these averages are still the same. You can see right here, you had this failure of all these moving averages right here, and it allowed for this market to break lower.
So if your brain hurts now, here's what I recommend. Go to a website like barchart.com and figure out how to use it, and just put different moving averages on the chart and take them off. Greg puts everything on the chart because he can see through all the lines and read. His ability to read these charts is, fantastic. If you're just getting started and you just want to start looking at moving averages, put one on, take it off, and continually change that time interval. Maybe add a couple more. Moving averages are extremely powerful. They're very widely used, which makes them powerful, but they have to mean something to you. So figure out what's comfortable for you to look at and for what for you to follow. But by all means, go to barchart.com and play around with it.
Yeah, and I think next week, Mike, we can look at Bollinger Bands. And again, so moving, when I look at technical indicators, you typically want to pick 3 to 5 to 7. And I really do 3 to 5, and they're just a tool in the toolbox. And when all those tools start to line up, then that becomes a good technical indicator on whether something's a buy or a sell. but just to use one, and look, you have people that build algorithms off of one technical indicator. This is where being a technician is just as much an art as a science, and that you have to figure out what works for you. And look, there are some people that hate technicals, and they just want to trade off of fundamentals and feel. That's fine. But for those that look at technical indicators, in my mind anyway, there's no holy grail technical indicator. It's picking 2, 3, 5. And when you get alignment of 3 out of 5, 4 out of 5, then that's a pretty good indicator of market direction and what you should be doing.
And here's something so important to remember. There is no holy grail. Absolutely. There's nothing that's going to make you right all the time. What you want to do is get yourself set with a couple of tools that will allow you to be right more than you're wrong.
Yeah, my favorite saying, everybody's a hero on the left side of the chart because it's already happened. So right. It's always obvious to say that this was a sell, but when you're in the middle of this and you don't have the right side of the chart, that's where the technical indicators can be useful as far as anticipating what lies ahead for a market.
If you manage your risk and you're right more often than you're wrong, and I'm talking like 60% of the time you're right, 40% of the time you're wrong, and you manage your risk, you'll do just fine trading. But if you're right 80, look, I know a guy who used to be right 80% of the time, and the 20% that he was wrong, he was so wrong he'd blow out all of his 80%.
Yeah, absolutely.
It's about risk management. All right, let's wrap it up. There's a lot going on. Hey, there's an overall theme here. We're really close to a bottom from a time standpoint, maybe from a price standpoint. I'll go out there and say it's probably not a bad time to get together a buying sheet and get ready to cover some business if you have business on the books. The one thing I would be very careful of here is running out and selling a bunch of business for September, October, November without covering it. The risk is way too high for the reward.
And the other thing, all kind of the old economic axiom, timing versus price. You get to pick one or the other. Rarely do you get to pick both. So from a timing standpoint, we know seasonally we're getting into that time frame where you bottom out. From a pricing standpoint, this is where it's critical for you to do your due diligence and understand your specific cash needs. What are you going to consume? What do you need over the next 4 weeks, 6 weeks? How are mills shipping to you? Are you mill direct? Are you end user direct? Are you pricing stuff out with vendors? Do they have that 30 to 45 day lag in their pricing? You need to rationalize your own business item by item. And then you use these tools as far as making educated analytical decisions where there's no such thing as a perfect decision, but at least do the homework to help make these decisions.
So let's wrap it up. Thanks, Greg Kuda, Westline Capital Management. If you would like the charts from today, reach out to Greg or myself. We'll get them over to you. As always, Materials Exchange appreciates your support. Here's what I can tell you about the platform in the last, I'd say, 4 weeks. Bids get action. If you want to get good pricing, you put a bid into our market, you will get a good. It's been working well for others. That's what I can tell you. So thanks, everyone. We'll see you next Tuesday. Thanks, Greg. See you next Tuesday.
Thanks, Mike. Thanks, everybody.